I would like to welcome everyone to the investor webinar today. My name is Michael Bover and I'm the founder and managing director of Family Wealth Advisory, where our vision is to help families live magnificent lives. I'd like to start the webinar today with an acknowledgement of country. In the spirit of reconciliation, I acknowledge the traditional custodians of country throughout Australia and connections to land, waters and community. I pay respect to their elders, past and present, and extend and respect to all Aboriginal and Torres Strait Islander people, the Maori people of New Zealand and the Indigenous peoples of countries where people joining today's meeting live and work. I'm really excited today to be able to bring a panel of experts to you. In a world of rising interest rates, high inflation, rising geopolitical tensions following Russia's invasion of Ukraine, the global decoupling and the rising US-China strategic competition, I wanted to provide our clients with some insights from our investment manager, Mercer, and two of our portfolio managers, Franklin Templeton and Pendal. Now more than ever, I think it's really important to have your family money actively managed by a team of professional experts. So moving forward, we will be providing regular webinar updates to our clients, with Mercer as our investment manager, providing the overview of markets and insights on portfolio construction. We'll then invite a couple of different fund managers from within the Family Wealth Managed portfolio to provide an overview as to how their expert teams manage money. That way, over time, you'll hear from all the professional managers within your portfolio and how they play a different role in helping secure your family money and optimizing your long-term returns. Today's investment update is being recorded and a copy will be emailed afterwards, along with a copy of all presentations. I would really like to thank the panelists for their time today and their participation in the investment update. Leading us off today will be Mercer. Now, Mercer is a global asset management firm that operates in offices in over 20 countries, with approximately 25,000 employees, combining global and local expertise, perspectives and solutions. They are investment specialists in capital markets, manager research, portfolio construction, responsible investment, and investment governance. Mercer is going to provide a market overview and also detail how they help Family Wealth Advisory build portfolios for our clients and how this portfolio construction addresses the current market challenges such as rising interest rates and high inflation. Joining us today from Mercer is Rebecca Jakes. Rebecca joined Mercer in 2018 and is head of portfolio solutions for wealth management. She has a deep understanding of portfolio construction, manager research, and managed funds. And following on from Rebecca, we'll have Andrew Kenobi, the Director of Australian Fixed Interest Income for Franklin Templeton in Melbourne, Australia. Andrew is responsible for managing fixed income portfolios, including macro strategy formulation, credit research, and portfolio construction. He has over 26 years experience in the financial services industry, and he will provide details on interest rates and current portfolio positioning. And finally, to bring us home will be Chris Adams, who is the Australian Equities Portfolio Specialist with the Pendal Group. Chris is a CFA charter holder and joined Pendal in 2014 after 10 years in Hong Kong as a product specialist. His area of focus is mainly equity strategies, and he looks after Pendal's key intermediary research relationships. Chris will cover themes in Australian economy, portfolio positioning, and provide some portfolio insights. At the end of the presentation, Rebecca, Andrew, and Chris will be available for some Q&A. So down the bottom, feel free to click on that Q&A section and ask any questions that you like. And if we have time at the end, we'll definitely try to address as many of those as possible. So now I would like to hand over to Rebecca from Mercer, who's going to lead us off.
Thank you, Michael, and good morning, everybody. As Michael actually alluded to, the start of 2022 has obviously been quite a different start to the year as to how we ended 2021. Essentially, with the exception of Aussie equities and some global listed infrastructure, all other asset classes have posted declines, really off the back of the fears over the tightening monetary policy, which is obviously being exacerbated by higher inflation and things like the conflict in Ukraine. Essentially, as we say, there was no room to hide, but we'll walk you through, as Michael touched on, how we try and protect the portfolio during these periods of market volatility. If we look first at what's been going on with the Russia-Ukraine crisis, the invasion by Russia into Ukraine, what it's essentially done is really increased dramatically the downside risks now in markets. It's impacted economies and markets via a whole host of different channels, but I think the most obvious and direct channel that we've seen has been where it's hit in commodities. The global market supply has now been disrupted, if not in some instances completely prevented, and particularly from Russia-Ukraine commodities reaching world markets. And this has really led to what you can see on the screen, a massive increase in commodity prices. And essentially, this is also exasperating that factor for inflation. If we turn to what is happening at a more broader scale, particularly at the Fed level in the US, inflation really has soared. Year-on-year rates now are at levels unseen for really decades. And we know the Fed is very much committed to bringing down inflation. The reality of it is there's probably two main scenarios that are now playing out. And we still remain very cautious because there's quite a degree of uncertainty as to which scenario is actually going to be the scenario that plays out. So scenario one is obviously where the Fed acts very aggressively and quickly, raises rates and tightens conditions, really desperately trying to obviously defend off that sort of, stagflation and inflationary pressures. The risk there, though, is that we fall into a sharp recession. During those sorts of environments, growth assets tend to suffer. And also, so does sort of your fixed interest bond sort of book side of the portfolio. In scenario two, where the Fed takes a more cautious stance towards raising rates, they then also run the risk of stagflation now taking hold. And in those scenarios, again, whilst growth assets tend to do poorly, there are some sectors that will do well. And again, some of your fixed interest assets can also suffer as really the cash flows are eroded. So it's about understanding that at the moment, those are the two main scenarios which are really creating a degree of cautiousness and uncertainty until we can see a stronger conviction ultimately as to which scenario path that we'll end up taking. So what are we doing about that? Well, essentially, we're constantly watching. We're looking at the supply chain disruptions and wage growth pressures that are underway. We're very much conscious of the fact that, inflation is there, wage pressure is there, and obviously central banks are taking a very hawkish tone. The Reserve Bank of Australia and New Zealand also just recently have all joined central banks in the US, Canada, and the UK, Norway, Sweden, and other countries in raising rates, And so there is also the flip side of that is looking at the valuations that are playing out in markets. And whilst we've seen some dip in those valuations, we haven't seen significant falls in them yet to warrant actually buying aggressively into those dips. And part of that is due to these geopolitical risks that both Michael and I have touched on, and I know that the speakers will also touch on further today. And really what those geopolitical risks do is essentially they're leading to greater volatility and greater risk on the downside, and obviously a degree of uncertainty, because as the situation between the NATO and Russia deteriorates, those tensions and those uncertainties are obviously rising more. So ultimately, for us, and what we work with Family Wealth and Michael and the team about is making sure that ultimately your portfolio's got enough diversification in it. In terms of volatility and in terms of uncertainty, your best defense really is to have as many drivers in the portfolio as possible so that you can exploit opportunities as they arise. And we also tend to favour a combination of both active management, and I know the managers that you're hearing from today will be in that area. If we look at the portfolios themselves, Mercer spends a lot of time actually stress testing them. So you can see that there's a chart on some scenario analysis. As the probability of those scenarios increases, obviously, we're reassessing and rejigging the portfolio asset allocation to better protect portfolios for impending scenarios. At the moment, we still believe that there is still some sort of balanced inflationary growth, which means that the portfolio is still well positioned ultimately to benefit from those scenarios. But as we talked about just before, there is rising uncertainty, and it's about managing those risks as we go through. In addition to that, we talk about being flexible. Now, for Mercer, when we talk about being flexible, we're not talking about tactical trading. We're talking about being able to capture market conditions and opportunities as they arise in that sort of medium-term horizon. So, i.e., as pricing, dispersions occur, looking at the opportunity set and making sure that we're correctly positioned. If we look at the portfolio today, we are still slightly more positive towards growth assets, and in particular towards Aussie equities, than we are towards sort of the global scenario and global growth. And obviously we are feeling a lot more neutral towards, sort of your fixed interest assets over and above cash, right? So we've been reducing things like your cash holdings. But building portfolios is also more than just about combining the asset classes. It's then about being able to improve those risk-adjusted returns through portfolio construction, working across the asset classes and within them to take, opportunities that will reduce risk through different strategies, but also improve returns, either through active management, but also through sometimes also using, core defensive sort of strategies or passive strategies that are very low cost, because that ultimately also assists in improving returns at the end of the day. So with the active management landscape, I think it is important to understand one of the great skills that come with active management is their ability to navigate through this time of uncertainty. And I think, as Michael touched on right at the start, the environment that we are now facing with accumulating price pressures, with this global divergent growth patterns, and with obviously the financial stimulus withdrawal, right, that is now occurring post the COVID sort of era. It's about navigating through this time of uncertainty. And that's really when we look for our active management to come to the table, to be able to be nimble and opportunistic, and work through this challenging sort of period of time. If we turn quickly and just have a look at the Family Wealth Australian equity portfolio, you can see we use a range of managers in there. And I've just put this up at the moment. I can appreciate it's a very busy slide. It's more just to show you some of the different style drivers that you can see in the portfolio. Pendal is here today, and they're going to talk around some of their outlook as well as some of the positions that they're currently holding. We regard Pendal as both a core manager in the portfolio, but also a high conviction manager. And really they're there to complement all the small cap managers. And we do expect them to deliver a consistent level of outperformance over the medium to long term. We love, as Mercer loves to put lots of charts and diagrams up, and these sort of give you some indication of sort of the different things that we're looking at across the book. So we talk a lot about style as well as sector diversification. And what I've also done is just provide you a bit of a snapshot of why they are one of our most highly rated Australian equity managers. And the fact that we have quite a great deal of conviction, not just in their idea generation, but also the way they build portfolios and implement them, and ultimately how it all comes together in the focused Australian share funds. Now, we've recently made some changes to the fixed interest allocations, and that's really been about trying to make sure that we've got the right drivers across the right spectrum of defensive asset classes to give us that protection as we enter this period of uncertainty. Franklin Templeton takes what we classify as a low volatility income approach. And in essence, it's there to provide you with some consistent income, as well as also complementing the other managers. But it takes a very much an active yet risk-aware approach. So it does provide some downside protection in that rising yield environment. Again, you can see sort of some of the metrics that we look at, and I have also just included a snapshot of why, again, Franklin Templeton, through their absolute return fund, is one of Mercer's most highest rated managers. Again, across those buckets of not just finding ideas to invest in, but building a robust portfolio that's sufficiently diversified and implementing it as well. So on that note, I'm going to wrap up and hand over to Andrew, who will provide some detail to Franklin Templeton. So thank you.
Thank you very much, Rebecca, and good morning, everyone. Thank you for the opportunity to share a few thoughts on fixed income in particular. So I'm going to move reasonably quickly. Just in summary, the challenges in the bond market year to date have really been about an aggressive move in the expected pace of rate hikes from central banks. That's clearly in response to the inflation pulse that's working its way through. We think there's some early reasons for optimism there, but I'll talk about that. There's clearly risks to both sides. And in that regard, we think bond yields are trying to navigate some sort of peak at the moment, but we may not see them sort of decline just straight away. It might be sort of more of a second half story before we see some stability. And we do think that Australian bonds in particular are quite unanchored from the path of the policy that the Reserve Bank likely takes. And then just quickly, I'll finish on some opportunities we're seeing specifically in the portfolio at the moment. So just turning to the next slide, clearly, as Rebecca said, it's been a very, very difficult start for the asset class year to date, almost across the board, nearly double-digit declines. And that's all been about the sharp repricing of what markets expect central banks to do over the course of the next few months. So you can see this chart here shows the light grey bars as it may on a 1 year forward basis, the amount of rate hikes that have priced by money markets for central banks. So Australia towards the left, almost tracking 1-for-1 with the United States, and specifically on a 12-month horizon, rate increases in the order of 3.5%, 350 basis points. We think that's particularly aggressive. If you look at the next slide, what we've done here is go back to 1990 and show every rate hike cycle that the Reserve Bank of Australia has ever undertaken. On the vertical axis, it shows the change from the trough to the peak of that cycle, and on the horizontal axis, the time frame under which it was taken. So, for example, in 99 and 2009, we had rate hike cycles that lasted a bit over a year and a half to 2 years. But from the sort of bottom to the top, we're around 1.5 to 1.75%. And the dark blue line is what the market now is currently envisaging. And again, this is being driven by global forces. Clearly, the RBA has started to make some adjustments, and they'll keep doing so. But for them to move this quickly and this much would cause quite a sharp deterioration in the domestic economy, we believe, particularly in terms of the impact on housing and consumer finances. So we think that is now in the price, and we think the risks are, if anything, from here, some under delivery, if you like. But what's driving this? Well, inflation is clearly a global story, and in terms of the developed world and what people are focusing on, it's really started with the US, which saw this inflation move quite early towards the end of the pandemic. Headline inflation here running at about 8.3%. What this chart here shows is that whether it's headline in orange or the different measures of core inflation, we are going to see a deceleration over the rest of 2022. Now, there is debate, of course, as to the pace and magnitude of that deceleration, but there's pretty much no disagreement that we are going to see inflation fall away. So we're looking at a couple of metrics here just to sort of gauge. I think, first of all, it's important to understand what's driven the inflation so as to have some conviction as to when or if we start to see this price pressure abate. Just on the slide we were just looking at before, what this shows is core inflation, which is in green, which is still quite high, but a differential between US retail sales, which is a good proxy for demand for goods, less industrial production, which is, of course, the supply side. And what we've done here is show that inflation is very much a lagging indicator. The inflation pressures we're largely living through now are a function of behaviours and policies that were in place 18 months ago. And so what we're now seeing is retail sales have actually moderated quite a lot in the US, and of course production has come back quite quickly. So, we're expecting and indeed observing that the core inflation for goods, which was very strong through the pandemic, will actually start to decelerate quite quickly. Another thing we're looking at on the next slide just shows the impact of fiscal stimulus and what we call the credit impulse, in this case of the United States, which was very, very strong, of course, as it was in Australia and other economies through the pandemic, led to a huge amount of money being created, and particularly money that was transferred quite directly to household bank accounts. And again, that has actually started to move quite a lot lower. In fact, we're seeing a contraction in credit creation. But again, inflation being a lagging indicator, we're not seeing the consequences of that just yet. But that's another small sign that we feel, gives us some hope that, this isn't the 1970s yet. There are some positives that we can take hold of. And then, of course, if we think globally what's going on, well, the blue line on this chart is a decision index from quite a large number of central banks around the world. And what it's showing inverted is that central banks are actually collectively tightening together. And so that's actually causing financial conditions across the world to tighten quite quickly. And we know that sort of concerted, coordinated behaviour does impact growth. And so the green line being the US key manufacturing index has started to show some signs of cooling. We expect that to cool quite quickly again in the next 6 months. So all of this is leading to a swift curtailment of demand, which is, of course, what the central banks are trying to achieve. Central banks, of course, can't conjure up a new wheat field or a semiconductor factory, so they have to attack the demand side to deal with some of these issues. Just turning to Australia, if I can, for a few minutes, because we've clearly also experienced some inflation pressures here. They're not insignificant. We don't think they're anywhere near as challenging as they have been in, for example, the United States. But interestingly, when we look at the kind of recent data, what this chart shows the difference between the CPI components that we'd categorise as discretionary. That is to say, you can choose whether or not you go and buy a new pair of shoes or go out to a restaurant, versus non-discretionary being the things we all have to spend money on. And if we break down that non-discretionary component, this chart here shows the biggest movers in the most recent release for the CPI index. So on the right-hand side, the dark blue is food, green is the cost of building a new house, blue is petrol, and then the orange is kind of the rest. And we know petrol prices go up and down, so that's the light blue. They've obviously been rising. Food prices, of course, have been impacted by a whole range of factors. As Rebecca mentioned, the war in Ukraine has put some upward pressure on bulk agricultural commodity prices, but we've had a perfect storm in terms of the floods in New South Wales and Queensland coming in the first quarter as well. What's interesting about this for us is the new housing component, which is not quite less than a third of the inflation pulse most recently. And of course, the pandemic saw a substantial surge in demand for housing for a whole range of reasons. But again, if we look at the next slide, what we're now seeing is some of those drivers are reversing quite quickly. So this chart here again shows the blue line being the lagged indicator of inflation for housing costs, and the green line being the outlook for the residential building approvals data for single family dwellings. And again, that, as we know and would expect, has come off quite quickly, having surged through the course of the pandemic. So we are clearly seeing the impact of a sharp drop off in approvals. We know costs for homes have been going up, and that's been leading to some demand destruction. Of course, interest rates having moved higher as well is impacting demand for housing. So all these things will act over the next 6 to 12 months to cool the housing market quite quickly and bring this into check. But of course, that will show up in the CPI data in coming quarters, if not the next year, rather than here and now today. We know that tightening works ultimately. This is a very busy chart, but essentially what it's showing is the bars in the charts here across Australia, New Zealand, and the United States is the flow of housing credit. The dark blue line is an index of house prices, and you can see in New Zealand, for example, where housing credit has really turned down quite quickly. House prices are cooling very quickly, and that's because mortgage rates have risen very quickly. In Australia, we only have a cash rate of 0.35%, but there's expectations, of course, that's going to move higher. We have the second highest household debt to GDP in the world, and we know that the average size of a mortgage for an owner-occupier across the entire state of New South Wales is around $810,000. So rate hikes are going to bite fairly quickly, just because of the nature of our consumer and our household debt levels. On the next slide, just quickly touching on wages, which is a very important part of the central bank's thinking here. They have been looking for this to move higher because of the way wages are set in our economy. It does take a while for this to flow through. There was some disappointment that the most recent release just a couple of weeks ago has this only running at 2.4%. Now, the RBA wants to see this at 3 to 3.5. They've decided to move earlier with their rate hikes rather than wait for this, which was their previous very clear guidance on the expectation that wages are going to slowly start to catch up. We think that's true. We think wages will, of course, start to inch higher. But we do believe that the probability of a sort of substantial breakout in wages that causes bigger problems for the economy is still pretty low. So of course there are anecdotes around very outsized gains in particular industries or where there's skill shortages, but at the economy-wide level, still likely to be reasonably contained. So putting all this together, one of the most closely watched surveys, and one we think is very important, the Westpac Melbourne Institute monthly consumer confidence survey. So this is a 3-month moving average. The actual current level of the index is down at around 90, and that really puts it at the lowest since August 2020. And if we take out that collapse in confidence we saw through the first half of 2020 when the pandemic hit, well and truly the lowest level of confidence in this country since the GFC. So again, if you look at the subcomponents of that survey, if you look at the confidence for people that have a mortgage, the housing related components, they're very, very weak. So we do think that just the outlook for interest rates, the concerns consumers have with the rise in non-discretionary costs of living, which is of course crimping some of their demand for other things, is doing the work, if you like, of slowing demand that the RBA is looking for. I just want to talk about, what do we do with all of this from a fixed income portfolio perspective? It has been challenging. I've talked about the drivers for government bond yields. Credit markets themselves have not had an easy time in the first half of the year either. So what these two charts show is the level of additional spread you get for owning an investment grade, so a relatively high quality corporate bond over and above a government bond yield. And so the top chart shows Australian spreads have been moving higher or wider, even as US spreads down the bottom have been a bit more contained. And that's not because the credit quality of the Australian market is inferior. In fact, if anything, it's higher quality. It's more around some technical issues and too much supply and some fund outflows and things like that. But that's meant that it's just been very difficult because, of course, spreads moving wider on top of yields that are moving higher kind of translates to lower prices at the end of the day. And so this chart here, just looking at the credit index as a proxy, you can see over the course of a bit longer than 4 months, the average price of bonds has moved down by nearly $7. The average yield to maturity is doubled and now above 4. And the average spread over a government bond has moved wider as well. And interestingly, the number of securities just in that particular index trading below their par price of $100 is now almost 80%. So in other words, most of those bonds you can buy at a discount to their face value. earn your coupon, and barring defaults, you'll get your $100 back, of course. For our portfolio, at the moment, the way we're thinking about things is things are fully priced. We do believe that the probability of more than 300 basis points of rate hikes from the RBA here over 12 months is exceedingly low. We don't want to say impossible, of course, because these are very unprecedented times, but we'll see that impact the economy very quickly. So our average yield to maturity in the portfolio it's actually getting up towards 4, sort of 3.7 area. The average security price across holdings of around 140, 145 positions, around 93 to 94 cents in the dollar. So a fairly big discount to their natural par value of 100. We have a little bit of duration. It's very difficult not to see some value in the government bond curve when so much has already been priced. But we're not that long, if you like. We're not that overweight. We do have some exposure. Importantly, quality within the portfolio is very high. So yes, we have around 50% in corporate bonds, the rest in some sort of government exposure. But the credit quality or the real default risk in our portfolio is extremely low. And I want to just give you, just to finish up with a couple of examples. So if you go back towards the end of last year, the actual US high yield bond market as a whole had an average yield to maturity of less than 4%. And that's for a market that sees defaults and is quite risky. Investment grade in Australia, just in some very defensive, high quality sectors such as the utility sector, which is very, very much government regulated, monopolistic in many ways in terms of the way it works, very stable. And the real estate sector, which is, again, very high quality names such as GPT or Dexus or Scentre Group, on average, 4 to 5 year bonds in those sectors are yielding 5%. So for a little bit of maturity exposure, but not too much, all of a sudden that combination of high yields and spreads which have moved wider is delivering prospective total returns which look quite reasonable for what we think is very, very little risk. A couple of specific examples, ones that we like. So the Port of Melbourne, which is a privatised asset, it's the largest mainland container traffic facility in Australia. Very, very long-term lease from the Victorian government and a very, very strong shareholding structure, including groups like the Future Fund and QIC. So they have a bond that's about 4.5 years in maturity. Its price has fallen from around $104 to 90. So, a 13+% decline in its face value in a short period of time, as its yield's gone from sort of 2 to 5. And again, that's a security that we think at these sort of levels is going to deliver very, very strong returns. So it's trading at a significant discount to its par value. Its yield is very attractive. It's pretty short dated. And the real risks are, for that particular facility, extremely low. One more example to highlight, Vicinity Centres, again, extremely high quality portfolio of retail, office and hotel assets in Australia. Extremely low gearing, very high occupancy, and highly diversified. So from a creditor's perspective, we're of course cognizant of earnings and profitability, but fundamentally we want to get our coupon and our principal back. Their bonds, which are 3 years to maturity, are trading around $95 and yields north of 4% for a single A rated security. So, fixed income is attractive, particularly some of these high quality corporates. If we look over 1 year from where we are today and imagine a couple of scenarios, so no change in yields for these two bonds, that's the second row from the top. Total returns are in the order of where the yield is, even a little bit higher. If yields just recover a small amount from those two securities, just on the prior chart, you can see that just the natural shape of the yield curve, where yields do move lower as you get closer to maturity. And we do in fact see some of this excessive pricing from central banks kind of start to retrace back to perhaps more realistic levels. So we're sort of calling that yields down 75 basis points. Then these two securities deliver returns of 6.5%, 7.25%. And of course, the reverse, if yields actually keep rising and surprise us, bearing in mind that over 12 months, bonds move shorter to maturity, total returns aren't too bad. This is still sort of close to 3%. So, we think a lot's priced in and we think there's a good buffer here. But, what are we doing? Well, in summary, I've given you a couple of credit examples. We have many of those in the portfolio. They themselves have been the biggest source of short-term underperformance as prices have fallen and yields have risen. That's really summarised on this blue line on the left. But we're doing lots of other things to try and add alpha along the journey, which is, if you like, gains that we're making to the portfolio and then realising, and then continuing to work to manage the sort of core part of the portfolio. So we've had active positions in a range of interest rate markets, US yield curve shape, and they've been working fairly well. So I might finish there. In short, we do think the outlook for bonds is starting to look a little bit more appealing, but volatility could persist for a bit longer, just as we're navigating this top in terms of where central banks are likely to go. Strong defensive names, such as the examples I've given, we think are now going to deliver pretty good returns, but we are sort of just managing to look at those at the individual level. And some of our macro positions have worked extremely well, and so where we can access those along the journey, we continue to do so. So I'll pause here and then hand over to Chris from Pendal.
Thank you very much, Andrew, and good morning to everyone. Thank you firstly to Michael at Family Wealth, to Rebecca at Mercer, our partners, for the opportunity to come and share our thoughts on Australian equities with you this morning, and thank you all for tuning in to hear them. I'm just going to start off just with a quick recap of where we've come sort of since the depths of March 2020, when we saw the trough in equity markets, both in Australia and overseas. And you can see here on this chart, looking at the red line for the US market and the orange line there for the Australian market, the strength of the rebound that we've had since that trough, sort of a little over 2 years ago. And I've shown you that there contrasted with the rebound in the US post GFC, which is that blue line there. And you can see there that what really stands out, particularly in the US, is the strength and the sustained duration of that rebound in equity markets that we've had. And there's really been three things driving that. There has been the enormous amount of liquidity that's been injected into the markets. There has been, the remarkably or unprecedentedly low rates, interest rates that we've had, the sort of central banks move to those emergency policy settings, and we've had a strong rebound in earnings. Now, what we've seen recently is obviously that very sustained run has come to an end, in as much as we've seen the first correction now. And why is this happening? Well, basically, two of those factors that I called out there in terms of liquidity and low rates have changed. We're still seeing decent earnings growth, which does provide a measure of support to markets. But really, we're at a point now where the market is grappling with a number of pretty large and sort of highly uncertain outcomes or certain questions in terms of the macro. And I'll talk a little bit about those first and how we're thinking about those in terms of constructing our Australian equity portfolio. So the first one is one that Rebecca touched on at the outset, which is the major geopolitical issue at the moment. There's a few going on, but the invasion of the Ukraine, in and of itself, in terms of the impact on global GDP, it's not huge in as much as Ukraine and Russia are reasonably small parts of global GDP. You can see there on the left, this is just for Russia in terms of GDP. It's only, it's less than 2% of global GDP, but obviously where it has the outsized impact is in terms of commodity prices, because they are both significant commodity producers across both hard and soft commodities. And this has important implications because it is feeding through to that issue of inflation, which Andrew's just detailed for us, and has definitely contributed to the short-term strength that we've seen in inflation. It's just the huge increases in the prices of some of these commodities. There are second-order impacts in terms of supply chain issues that are feeding through as well. So This is, it's a highly uncertain situation, and we're certainly not calling which way it goes. The only thing we can say, with any certainty is that it is contributing to that inflation. But we also must be mindful that, this is an area where it is hard to get any degree of insight, and this could potentially be a source of good news if we do see some ceasefire there. And again, so we just need to be mindful that things can change quickly there. But over the longer term, I think it's fair to say that, it has demonstrated the vulnerabilities that exist for places like Europe in their concentration of supply into places like Russia, which will feed into this longer term trend that we're seeing in terms of greater latency and deglobalization being built into supply chains. And that is important because it drives opportunities for some companies, but it also, again, plays into this longer term of inflation. So we've put that to one side. And the second big issue that people are talking about or thinking about at the moment or grappling with is China. And again, there's a number of different aspects of what's going on in China which we need to consider. In the near term, what we've seen in terms of China and its zero COVID policy and the shutdowns that have resulted from that is an exacerbation of some of those supply chain issues, which were showing and continue to show signs of easing in the US. But an enormous amount of ships sitting off Shanghai now for some time, which again has sort of caused some of those supply chains to jam up a little again. So it has that near-term impact. The broader question is around Chinese growth, and there are a number of challenges here that China is grappling with, all of which really come back to this inherent contradiction between zero COVID on one hand, which is very closely aligned with Xi's sort of persona. This is his policy. He's going for sort of an unprecedented third term as president this year. And the zero COVID policy has been touted as an enormous success for China over the last couple of years. So it's very hard for them to turn off that policy. Trouble is that's in direct contradiction of their economic aims because the lockdowns are having such an enormous impact on Chinese economic growth. So we are seeing Chinese economic growth being dialed down from previously it was sort of expected to be somewhere in the 4 to 5% range this year. That's since been dialed back by bodies such as the IMF to somewhere in the 3 to 4% range. But China is trying to walk this tightrope at the moment. There's been a number of policy initiatives just in the last week or two. There was an extraordinary conference call from the Premier Li Keqiang to various levels of government emphasising the importance of driving economic growth in China this year. So they're walking a policy tightrope, and the uncertainty of how that plays out is definitely something that's weighing on investors' minds. And it's important for us here in Australia, most specifically around the outlook for the resource sector. It is a sector which has benefited from high commodity prices, but we need to watch the outlook for China to sort of get a gauge on how demand is going forward. But just in terms of looking, some key things to be watching, the top left, if we just go back one slide, the top left chart there is the housing market, which is an enormously important part of the Chinese economy. You can see there where volumes have been this year in black versus previous years, and it's been very weak. We've seen some policy easing there. The question is whether or not that actually stimulates that market or whether or not it just sort of avoids it falling off a cliff. Again, we need to wait and see there, but you're seeing freight activity, you're seeing inflation in terms of pricing materials. And interestingly, because the renminbi is pegged to the US dollar, you're actually seeing China's competitive position erode as the dollar strengthens versus its sort of key competitor currencies, such as the Korean won and the Japanese yen. So a number of issues facing China, and it's a key area to be watching. If we move to the third issue, and this is, sorry, the next slide. This is the key one. This is inflation. This is what Andrew's been talking about, and I think we would concur with a lot of what Andrew has been saying in terms of a lot of those short-term issues seem to have peaked and are improving at the margin. So to a degree, as much as the transitory line from the Fed has been derided, there is certainly a component of the inflation that they were seeing which should prove to be transitory, and we are seeing that improve. The question for us is, as inflation comes down, what's the level that it ultimately settles at? And again, this is still yet to be determined, but there are a number of issues that we're looking at, such as investment in green energy, such as the deglobalization of supply chains that I mentioned before, which might mean that inflation very much or very could settle at a higher level than we've seen for probably a couple of decades now. Again, we're not talking hyperinflation, we're just talking a bit higher than we are. That does have implications for the investment environment. If we move to the next chart, please. This is sort of how we're thinking about it at the moment, because the answer to that question is where inflation goes, is still uncertain. And the question at this point is, do we move back to the immediate post-GFC environment where growth was very low and interest rates as a result were also very low? And you can see that second phase here on this chart. This is for the US and the lower bound of the Fed funds target rate. And although expectations at times were that the rate would start to move up, that's the orange line there, it didn't really for a lot of that period. And when it did in 2018, we saw it pivot very quickly as signs of market weakness came through. The question is, do we go back to that environment, or do we go to an environment where growth is stronger and where interest rates and inflationary expectations are necessarily a little bit higher? And that, we don't have to go back too far to see that kind of environment. That's sort of like the pre-GFC environment. You can see there that we did have more of an sort of classical interest rate cycle in blue there. So that's a big question at the moment. As I said, it's unresolved, but you need to think about that and certainly that's something we think about when we build the portfolios, because you need to account for sort of either situation. If we move to the next slide, please. One thing that I would note is it isn't just about interest rates. To combat inflation, and I'm talking very much within a US context here, it's about total financial conditions, which include things like equity markets, which include things like credit spreads. And this is the Goldman Sachs Total Financial Conditions Index. And you can see there that we have seen sharp tightening. This is as at the start of this month, and that's tightened quite quickly even further. So we're probably back to kind of that long-term average now. So conditions are tightening very quickly, and Andrew mentioned that we're seeing that coming through in various different ways. The question remains, how much further does the Fed feel they need to go to make sure they stay ahead of inflation? And as I said, that's sort of still that's an outstanding question at this point. If we move to the next slide. Key point I want to make with within this environment is Australia is very much a market for these times, and it's the first time we've been able to say that in quite some time. Australia has been a material underperformer of US equities and global equities for some time now, but a lot of the factors which drove that underperformance have now swung about to actually become quite supportive of the Australian market relative to other equity markets out there. And we can see that, first and foremost, most simply in year-to-date performance. So this is the calendar year-to-date performance. This is as at the 10th of this month of Australia there on the right, versus other markets around the world. And you could see then the Australian market was only down 4.1% versus 15% for the S&P 500 versus 25% for the NASDAQ. In the rebound that we've seen in the last couple of weeks, that figure for Australia now sits at down 2.5% for the calendar year. The US market down 12% and the NASDAQ down about 22%. So the Australian market has held up pretty well in what's been a pretty volatile environment for a lot of overseas equities. The reasons for that, firstly, because as Andrew mentioned, the inflationary problem is not as acute here. So there isn't the same need to raise as quickly and perhaps as high as we're seeing in the US. A couple of other reasons, if we move to the next slide, please. Part of it comes down to the makeup of our market. The parts of the equity market which are hit hardest by rising interest rates are the long duration growth names. That's your technology names, your healthcare names, which have done very well for many years now. The US has a lot of those. You can see there on the left, healthcare and IT is over 40% of their market. Australia comparatively has far fewer. You can see there, it's about 10% of our market over there on the right. And instead, we have a lot of banks, and a lot of financials who are notionally beneficiaries of higher rates and higher bond yields. And we've also got a lot of energy and mining companies, which are doing well off the back of higher commodity prices and are seen as inflationary hedges. So that market makeup is working in Australia's favour as well. And if we move to the next slide, please, we also had a lower valuation starting point. This is the valuation of the Australian market there in gold in terms of its price to earnings ratio, a measure of how expensive the market is. And you can see that versus the US in blue, we never got to the same degree. We were never as extended as the US market was. And so, not starting as such an extended point has certainly helped the Australian market. So we're seeing the Australian market, near term still cautious. We think there's still a lot of volatility. What we're going through at the moment looks like a classical bear market bounce. So, we're still cautious in the near term, but we are very mindful there's a lot of opportunities and there's a lot of mispricing driven by the current uncertainty opening up. So we're starting to position the portfolios for that. And if we move to the next slide, please, the final point I'd make on sort of the broad market is that earnings is holding up very well. These are earnings revisions for the next 12 months for the Australian market. You can see that they plummeted there around COVID. We saw that rebound, through the end of 2020, the start of 2021, the subsequent variants that we've had coming through and subsequent lockdowns obviously hit those again. But we're now seeing the rebound and earnings growth, as confirmed by the most recent reporting season, is very strong in the Australian market. And that's important because ultimately stock markets are driven by the combination of earnings and the valuation rating. And what we've seen pretty much around the world is that valuation rating come down while earnings have actually held up pretty well. Now, again, if we do start to see the US slip into recession, that will have an impact on earnings, and earnings, will necessarily moderate from what are pretty strong levels. But as long as they don't collapse, that's still pretty supportive for equity markets. And if we move to the next slide, I'll probably move just one more forward. Just to talk a little bit how we're positioning the portfolio. What I've described is a lot of uncertainties and not many answers to how all that unravels, because no one has those answers. But what we can do is build a portfolio which is going to perform across a range of different scenarios, and that's the way that we always manage money. I should stress this slide is not intended to be investment advice. Please don't rush out and buy these stocks. They're held in specific sizes to perform specific roles in the economy, in the portfolio rather. But what I wanted to do is sort of give you an overview of how we're thinking about this market and how we're positioning. So you can see there's different kinds of stocks in the portfolio. We've got our defensive names, such as Telstra, which, after a pretty sort of challenging period has sort of reverted to its old role as sort of very defensive yield within the Australian market. You've got Evolution, who's a gold miner there. And again, that was a position which performed very well during February. During the Ukraine invasion, we saw a flight to safety, and the positions we had in gold miners helped the portfolio outperform during that period. So we have our defensives there in case, we do see a material downturn in sentiment. We have some growth names. These are names which haven't performed well in this environment that we've seen recently of bond yields going higher. You wouldn't expect them to perform well in that environment, but once we do get to a scenario where people start to have either a little bit more certainty or around the path that the Fed is going to take, or they get some conviction that perhaps inflation is starting to ease and the Fed won't need to be as hawkish as they're currently indicating. That's the kind of environment then where we think you can see growth start to outperform again, but only, in our view, a specific kind of growth. It's that one where there is a very strong fundamental story, not so much the speculative names that we've seen sort of perform over the last couple of years. So, names such as Xero, which is cloud accounting and cloud-based accounting, and CSL, one of our leading healthcare stocks. There's a very strong fundamental story, and they're names which are starting to look pretty attractive at these levels, given underperformance recently. We've got our franchise winners, which are companies just delivering on a very clear strategy very well, where they're probably a little bit less sensitive to what happens in terms of this question around inflation and policy and where rates go. So they're names that just sort of keep chugging along and doing well. We've then got our more inflationary sort of hedge part of the portfolio, which is commodities, companies like BHP, companies like Santos, but also companies with strong pricing power. And that's something that we're really looking for pretty much across all our positions in the portfolio at the moment, is companies, we're sort of looking for companies which are defensive in this environment, which means, the ability to defend margins, the ability to pass on cost pressures, and the market really likes cash flow in this environment. So they're the kind of companies that we're looking for. We'd put Metcash in that space. And then we've got our companies which were ones which were hard hit by COVID, but which are now enjoying the rebound as we see the normalization in the economy. You know, Qantas is probably the poster child there. So it would be hard to find a company which was harder hit by COVID than Qantas. You know, they move very quickly to shore up their balance sheet, and they've really used the COVID period where they weren't flying as an opportunity to really redesign from a blank sheet of paper. They've changed their cost base. They've really focused on where they want to be flying, and now they're seeing a rebound in demand, and so they're very quickly getting back in the domestic market to above pre-COVID levels of traffic volume at the moment, and they're doing it at pricing levels which allow them to pass on the cost pressures they're seeing from oil. So Qantas in a very good position at the moment, and we're seeing the rebound in international as well. It's taken slower to come through, as you'd imagine, but they're already back above 50% of pre-COVID international capacity, but their revenues already back to, I think, above 70-75% because they're able to do it at higher prices than they did previously. They're in a better competitive positioning. So that just sort of gives you a snapshot of not all the positions in the portfolio, but some key ones. And really, as I said, what we're trying to do here is that, if we do get an environment where inflation is stronger than people are currently expecting, then we'd expect sort of those pricing power part of the portfolio to do well. Conversely, if we do see an environment where inflation starts to moderate, where expectations around the hawkishness of the Fed or of the RBA start to moderate, you might see some of those growth positions start to do well. So we're not making a binary or a heroic call on how we see things panning out from here. It's about building a portfolio which can manage that risk, but making sure we've got the best companies within the portfolio that we think can drive performance. And with that, I will hand you back to Michael.
Thank you, Chris. That was great. I'm just mindful, we've probably got 3 minutes before we wrap up. So, Chris, I was just going to ask a quick question. With the recent building company collapses, do you see any impact of that on the broader Australian equity market?
In terms of listed equities, not so much. I think it is reflective of the cost pressure that we're seeing pretty much across the market. There are very few companies that we spoke to, in the wake of the recent reporting season, who weren't seeing cost pressure coming through, be it through materials, be it through labour. And, that obviously was the issue in the construction industry, where you've got fixed contracts, but they're getting squeezed on prices. So I think in the listed space, there isn't too much. I mean, the only sort of company that we own which might be affected at the margin might be a James Hardie, but it's a very small part of their business. Really, the key driver there is what's happening in North America. So I think, it is more, it's sort of symptomatic of the cost pressure that you're seeing coming through, and that's something that you need to be very mindful of with investing in Australia at the moment. That when you're looking at companies, you need to understand their ability to pass on that cost pressure.
Yeah, great. Okay. Really appreciate that, Chris. I really appreciate your time, and Andrew as well, and Rebecca. Really appreciate you making the time for Family Wealth and our clients. It's been absolutely amazing. Now, we are sort of running out of time, so if you do have any further questions, please do reach out to either myself or Robert Hill or Vaughan Brand, the two other advisors in the practice. Be more than happy to answer any of your questions. So thank you again for today, and we look forward to the next one.